Welcome to RetireCoast.com and our Generation X 20 Years to Retirement series. Watch all of the episodes in this series, which will take you through every task necessary to plan for a successful retirement. Then go to RetireCoast.com and read our companion blog articles that contain tools and links to assist in planning. Please leave comments about this video so others can benefit from your thoughts.
Welcome to RetireCoast.com. We're going to talk about the best retirement budget tool. Before I start, I want to explain how this works. This budget tool is provided as a Google spreadsheet with several tabs. You will have access to this, but in order to use it, you're going to have to save it to your drive. You go up to File, and you go to Make a Copy. It's really that simple. It'll open up in the copy that you've made, which will be on your computer. You need to make a change to the name of it. If you want to, take off the word copy. But from that point on, you're going to be working on your own computer to go through this. If you try to save it or enter on the actual screen when you first open it, that's not going to work for you. That's not the way it's set up. So go in and File, make a copy, and go through that process. RetireCoast is a blog site that is dedicated to helping people understand a lot more about retirement, what it means to retire, not just the financial side of it, but a lot of other aspects as well. My name is Bill Anderson, and I am going to take you through this. It's part of a multi-series that we've created of blog articles and companion YouTube videos to help understand the complexities involved with Social Security, filing a tax return, 401ks, lots of things that you need to know about retirement. And we hope that you stick with us and you go back through our blog articles and you read them, hopefully in order, but not, that's fine, and go back to them as often as you need to gain some insight. We'll be providing a lot of different tools and calculators along the way. This is the primary one. If you don't know how to create a budget, we'll talk to you about that, but it's important for you to know where you're going to go. Otherwise, how would you know if you got there or not? So originally when I thought about going through and explaining how to use this budget tool, I was going to start entering information and show you how cool that was. However, I decided that I need to spend more time explaining things about the process, and I don't want to go on for an hour and a half about this. I want to make it pretty simple. So what I did is I pre-entered some information, and I'll show you by taking it out what it looks like if we make some changes to it. Now the blue here, 1500 for example, is where you enter. The black is where you stay away, such as this number over here. Most of these are protected, but you can change any of the blue, and if you need to enter another line in there, you can do that too, although I left a few that say other. The best thing to do is if you're not going to use something in here, for example, home cleaning service, you don't think you ever use it, just type over it and put something else in there if we've left something out. I think this is pretty complete. There's a lot in here, and I'm going to go through that in just a moment. Now you'll see some tabs down below, down here. Replacement, savings, financial, health, food, and debt. The reason that we created the tabs is because the spreadsheet would be far more complex if we did not. We broke down some of these things where there's multiples in it. So I'm going to go through all of those with you here, and I just want to give you a kind of an overview of the spreadsheet itself. And this is a sheet. I wouldn't recommend trying to use it with your cell phone. It's not going to work well for you. And you can see there are lots of different categories here. So I went through that real quick. We'll go back through it again. I'm going to start down here with this tab called Debt. And so what we have listed here are things like credit cards. Now you can type over MasterCard, you can put it wherever you want here, and then the monthly payment and the total owed. Now we want to make sure that you don't double dip, so to speak. So if there is an amount listed in the master budget, don't put it in here twice. Either put it in on your MasterCard as a debt that you owe, or put it into the budget. And as I said, you'll notice that when you get to it. So there's places for personal loans, student loans, lots of things on reoccurring monthly debt. Now the theme of this spreadsheet is monthly information. We need to break this down to the smallest number possible. If you are paying a bill on an annual basis, and let's go to another one of these, and let's go to health, for example, where you are, once a year you buy a wheelchair, and you spend $200 in that wheelchair. What we're going to end up doing is breaking that down to a monthly number for budgeting purposes, in which case, let's say you were going to buy one in 4 months, and so you would set the money aside each one of those months. In this case, we're saying the lifetime here is 1 year, but for a wheelchair, the lifetime may be 10 years. In that case, you put 10 in here, and it's only $20 a month when the initial cost is $200. Okay, so let's finish this one up. The healthcare one is a little more complex than the others because there are lots of things to put in here. So your Medicare supplemental, if there's two of you, then as I set up here, there's it's $40 plus $40 and put in $80, and that's your annual cost there. This happens to be monthly. Now we're going to get down here to the visits you're going to make for the different types of doctors. You can enter others in here. How many visits, how much is the cost per visit, and here is the annual cost. We're going to go to prescriptions. You can actually describe what those are here, and you can put the number of refills you need in a year, and then here's the cost of the refill, and of course it gives you the annual cost. Again, we went from monthly here to annual here. We're going to go into, as I mentioned, these things like electric scooter, electric bed, some other things that are really more on the medical side, and you're going to put those in, and there's going to be a one-time cost, but we're going to spread that out. So we end up with $115 a month here in the health. Let's go back to the food. What we did is we said, here's restaurants. So if two people ate at a restaurant once a month at $60 a cost per person, that's $120. Grocery store, two people at $300 at $150. So that's $300. I don't know how 302 get in there, but that's $300. And then we have $422 here, and we're going to go to financial now. On financial, we have legal fees, we've got IRS fees, we've got IRS repayment, financial planner. We put in here you're paying for a financial planner, and this is about 5 months to pay this, so you're going to pay it for $40 a month for a total of $200, and then here's our $40 a month amount here. Now, these monthly amounts will fall off and add on, as you know. If you pay off a credit card in 6 months, then there won't be a payment unless you charge it again. So you'll have to go in and make changes to this on a periodic basis. This has to be a live document to work well. Under savings we're listing here as an expense because it's coming out of your paycheck, it's coming out of your Social Security, it's coming out of something, and it's going out, it's not coming in. So it's listed as an expense. All these things here are expenses. So you're putting in $200 a month in your 401k because you haven't retired quite yet, and you are putting in $100 a month in a Roth IRA. So here's your annual amount, here is the monthly amount that goes into the sheet. Then we're going to get into replacement. Now this is where things get a little bit more complex. Everything that you own wears out over time. Everything. It's called entropy. It's one of the laws of thermodynamics if you have studied physics. And it just says basically that refrigerator has a useful life. So let's say, for example, that you're going to need a new refrigerator in 3 years. So you put lifetime as 3, and it costs $1,000. You're going to need to put away $27 a month for that refrigerator. You're going to need a new roof in 10 years. That's $75 a month, for example. So here we have $102 a month, and you have to go through all these things. Now, we just put in some of them here. There's even more over here. Driveway repair, repair of lawn equipment, lots of costs. If you don't get all these costs down, you're going to hurt yourself in retirement, because you can't ignore the fact that they're going to happen. And we try to make this as complex as possible in terms of the number of things. We don't leave anything out. I'm telling you, if you have a fence, unless it's a brick fence of some kind, even that will wear out. But if you have a wooden fence, it's going to need repairs. If there's an HOA special assessment that comes, if you have to call a tree company to trim trees, if there's a storm perhaps, something like that, the garage door opener is going to fail at some point. So there's more to it than just these items over here. You can put those in here if you want to and make this bigger if you think about it. As we continue to improve this, we'll be adding to it in the future as well. So let me go back over to the budget, and I'm going to show you where we carried over the information on the tabs. So we have one of these tabs here under debt. That's the carryover from the debt tab. These are the other tabs. There's carryover from each one of those. Now, what we did is we set this up so a lot of people relocate in retirement, at least they consider it. For you to be able to consider the difference in cost between where you live now and where you could live, we put in 2 columns, and that's the point. So in this demonstration here, we're saying you're paying $1,500 a month here, but you could be paying $1,300 in your new home. Maybe it's less, maybe it's more, but there's a $200 difference so far here. There's nothing in these 2 columns here. We put in some household insurance, which will be less in one area than it is in another, and some other costs that are somewhat similar. 90/90, for example, cable is about the same. Some things aren't. We have HOA dues here, but there aren't any over here. And so now we end up with, in this total here, it's $2,740 compared to $2,415. So this new place you've selected to possibly move to will cost you less money to live there. Under monthly obligations, these are general obligations that don't have anything to do with the house, but there are car payments. So let's say you have no car payment, but you do have car insurance on 2 cars. We put this in here, and what you want is you pay that every year, but you've got to divide it by 12. Put in 1/12 of that annual amount for insurance in here. Everything is monthly, as I mentioned on this sheet. Okay, and then you've got an RV payment, perhaps, RV insurance, vehicle maintenance. You've got vehicle registration in all your vehicles, and here's the debt from the debt tab, as I mentioned. So there's about $600 here and $580 here, so you save a little bit on this side. On the living expenses, we went through all of these things here. So we have some things like clothing and fuel for the car and fuel for the boat, household cleaners, gifts that you have to give. Again, you take the annual number, divide it up by 12, and you come up with a 1/12 amount for some things. Same thing with Costco membership or Sam's membership. It's an annual membership. Divide it by 12 and put the amount in here. We left some of these out here just to facilitate and get through this extensive list here of items. And we ended up with $1,488 and $1,548 here. So this place that you're planning to move to is a little more expensive in this budget section. So that's the end of the discussion of expenses and how the expenses will be going into this. Now let's talk about investment income. If you have a 401k plan, it's taxable when you take it out. So we have said that you have $100,000 in there today. Now, by the time you retire, you may have more than that. So if you're going to do this, as I suggest, based on everything today, if you retired today, you can see where you're at. You can also then save a copy of this and then go and make another copy of it, just like you did before. And you can change the title up the top here and say that this is current budget, and then go in and check what it would look like if you have a new budget. And the new budget might be your forecast for what's going to be like when you're 70 years old and you're retired. And then maybe you've got $500,000 in here instead of $100,000. The rate of return here is 7% is the average return in the stock market on equities and things that you invest in your 401k. And that's the average over about 20 years. If you're doing better, fine. If you're not, then you can put something else in there. But try to keep an average number in because you've got a lot of years to go. This is the IRA, which is taxable also when you remove it. Let's say that there's two of you, so you put money in both of those. And then we have some investment property. Now, if you have investment property or any other kind of business, you want to bring over the net income that's before taxes. So we put the net income in here, and the net income rolls over. Now, we end up with the annual income here, okay, from 7%, for example, and this is the monthly income that we're getting from our investment. I put in, digital coins, and now we've got the Roth IRA, which are non-taxable, and you have $5,000 in the Roth that's non-taxable, and here's the income that comes here. Now, the taxability of these things will come into focus here in just a moment. Then Social Security, we put in $2,900. Now, the maximum you can get right now is just a little over $4,000 if you retire at full retirement. And that's going to change over time. Of course it will, but using today's numbers. Now, most people aren't going to get anywhere near that because you have to earn upwards of $140,000, $150,000 to max out every year. So most people don't earn that kind of money. So I put in $2,900 here for one of the earners, and then $1,600 for the other, when $1,700 is the national average right now. So there's two of those incomes, and there's the total income there. Now, Social Security, 85% of it is subject to tax. There are some strata there that you work on depending on how much income you have, but based on the investment income here up above, it's going to be based on 85%. The other 15% is not taxable. Now, there is a state taxability, and since there's no way to know whether your state has a tax or not, we left that blank, but you can put in the total gross amount, and you can use a formula down below that we have for state taxes on Social Security. There's not very many that tax Social Security. Now, we have a taxable pension here. There aren't many people that get a pension either anymore, defined benefit plan, but I could put in 1,000. I'll show you what it looks like, and then that rolls all the way down. So let's take that back out again. Then we have investment income that comes from up above right here, and this is taxable investment income. Now you can see the difference here. This is your investment income, and that number is different, okay? Because that's the total, and this is the taxable, because we've got some non-taxable in there. Now we have non-taxable pension right here. We just threw that in there just to fill in a space, make sure the math all worked. And then we have non-taxable Roth right here, and that's the amount that came from up above. Then we have taxable wages right here, and this would be if you were working at a full-time job or part-time job. These are W-2 wages here. Most people aren't going to end up with Social Security and wages. So I'm going to take these out for now, right now, and we might have to put it back in again. Sometimes you get a part-time job, for example. So then we have, this is a federal taxable and the state taxable wages or investment income. And then we have, this is the federal tax rate that I put in for the amount that this amount of income should probably be taxed. Now, you can go into the IRS.gov and you can take a look at the tax table there. You might not be at 15, you might be higher, you might be a little lower. There's one more tax rate lower than that. This is the state tax I told you before. You could put 0 in here, or you could put in whatever the state tax is. In California, it's they don't charge on Social Security, but other states that do charge on Social Security, they'll have a rate, and you can put that rate in there. And both of these numbers here are for your current home and your future home on the other one. Then this is the federal taxes that you'll end up paying right here. You'll end up paying $823 in federal taxes. And then we've got income after tax here. And then down here we've got, this is all the information from here, from all these tables here. And this is your total expense right here. This is your total expense here. Now, these numbers are yellow because they're positive numbers. What this says, this budget, the way you saw it with everything that's on here, you will have $514 a month remaining as discretionary income if you stay in the current home. The new home, you would have $899 a month in discretionary income that you can spend on something else. Now, I'll show you what this looks like if, let's say, the house payment was $2,500 here, and it was $2,000 here. So we're going to come over here, and we're going to see that it's negative. That means that you were short $485.86. This one comes down to a positive $199, and that's because the rent went up. So when you're working with this, you have choices to bring in more income or reduce your expenses. And if you find out that, for example, that you are not going to have all this money here, and you are not going to have all of this here. Let's go back to the $1,500 here and the $1,300 here. And let's go back down here, and we'll see that we are still at the positive. Now, I'm going to take out some things. I've given you too much credit. Let's say, for example, you don't have any investment properties. Many people don't. I happen to, so that's a good thing for me. And let's say that you don't have one of these is gone. Okay? And let's see what happens down here. You're still net positive, so you don't have to save as much money. At least that's the way it looks now, but then prices will go up. And also, we didn't fill in a lot of other things here. We didn't fill in down below here. School, entertainment, airfare, vacation costs, for example, pet expenses, personal grooming. I mean, what if we put in there that you need a haircut every month and your spouse needs a haircut every month, so you have $100 here and $100 here, and there's more to put in there as well. And now we're just above the threshold there. If we come down here to the Social Security benefits, let's say you're making $2,200 a month on Social Security. One of you are. That's a negative $476.40. So what will you do? Well, if you can't increase anything else because you're retired, remember, what you can do is this. You can get a part-time job, and you can put a number in here. And let's say that number is, what, you need $500 there? So we're going to put a part-time number in here of $600. Well, more than that. We have to pay taxes. So we're going to put $800 in here. Okay? And let's see what that turns out to be. It's $155 a month. So the answer, at least early in retirement, is probably getting a part-time job. Okay? Or one of the other things you can do is take this out, because you want to lay by the beach. And here, when you're working, you've got 20 years. Let's bring that up to 200,000. And let's bring this up to 200,000. And let's see, 2 million, that would be nice. Let's go down and see where we're at. And look at, we're positive. So if you save more money, you can stress less in retirement. And that's what we're looking at right here. So you can use this budget to change everything from what you're going to spend to what you're going to bring in. You have the time to do that, and if you listen to our other podcasts and our YouTube videos and our read through our articles on our blog site, you'll get a real good idea of how you can get set up for retirement. We're going to talk about everything. We're going to talk about saving. We're going to talk about how to set up that 401k, how to take advantage of what the employer has given to you, not necessarily the actual investments because they'll change from time to time, but the types of investments and the way that it works best for you, when it's the best time to take money out to avoid paying the higher tax rate later on when you're retired. And we'll get into everything from buying a house before you retire, everything. I mean, literally everything. So follow us, and you'll learn what you need to learn, and you won't need to stress. If you start planning now, particularly if you're a Gen Xer and you've got 20 years to go, it's enough time. It's enough time to take care of everything, and there's no reason, as I said before, to be stressed about retirement as long as you're doing something about it and you actually have a plan. So start thinking about things we're going to get into, such as where will you live in retirement? I know I have a lot of family in California, and they tell me they can't afford to stay there in retirement because even if they could stay there in retirement, it would take everything that they have just to barely keep even. If there's anything that went wrong, they'd be upside down. If you want to move to an area such as the Mississippi Gulf Coast, for example, where I'm at, where costs are 35 to 40% less than they are in California, then you can save a lot of money. And there's some options to move before you retire. Why wait? Why throw the cash away? Start early. And as I said, we'll get into all of those things. So thank you very much for listening to us, and I appreciate you coming to RetireCoast.com's YouTube video and our blog article. Thank you. Well, this is Bill Anderson again. I just wanted to remind you that this is only one episode of an entire series on Gen X retirement. So if you have gone through this one and you like it, please then go through all of the other episodes that we're going to be publishing on a weekly basis, and visit our website, RetireCoast.com, to read the companion article that we're going to write in our blog. That has a lot of tools in it and some other information that you need. So between the YouTube video and that blog article, you'll have what you need. As a matter of fact, you can go to the blog article and there's a link to the YouTube video that the blog article is written about. So perhaps that's the best way to start. Well, thank you very much for coming, and I hope that you're listening to us in the next segment.